In the world of finance, two prominent players take center stage: debt and equity. Think of them as the two primary ingredients in a company's financial recipe. Debt, put simply, is borrowed money. When a company takes on debt, it's essentially taking a loan that needs to be repaid with interest. Imagine going to a bank, borrowing money and promising to pay it back over time. That's debt in action. Equity, on the other hand, represents ownership. When you buy shares of a company's stock, you're essentially buying a piece of that company. You're now an owner, and your stake in the company's success or failure is directly tied to the performance of those shares. Understanding the difference between debt and equity is crucial for investors and business owners alike. Both play vital roles in a company's financial structure, and striking the right balance between the two is a delicate dance. When a company utilizes debt financing, it agrees to repay the borrowed amount along with interest. This interest expense represents the cost of borrowing money. The interest rate determines how much the company pays on top of the principal amount borrowed. A higher interest rate means greater expense for the company. A key metric used to assess a company's debt level is the debt-to-equity ratio. This ratio compares a company's total debt to its shareholder equity. A high debt-to-equity ratio suggests that the company relies heavily on debt financing, which can be risky. Each debt agreement comes with a repayment schedule. This schedule outlines when the borrowed funds must be repaid. Lenders typically require regular interest payments and often structure loans with specific maturity dates when the principal amount is due. Equity, as we've established, signifies ownership in a company. When you purchase shares of a company's stock, you acquire a portion of ownership. The percentage of ownership obtained depends on the number of shares you hold relative to the total number of outstanding shares. Return on equity, ROE, is a crucial metric for evaluating a company's profitability. It measures how effectively a company generates profits from its shareholders' investments. A higher ROE generally indicates better profitability and efficient use of shareholder funds. Dividend yield is another significant metric associated with equity investments. It represents the annual dividend payment per share as a percentage of the stock's current market price. Investors seeking regular income streams often look for companies with attractive dividend yields. Both debt and equity come with their own sets of advantages and disadvantages. Debt, while it requires repayment with interest, can provide tax advantages as interest expenses are often tax deductible. Additionally, debt allows companies to retain full ownership and control. However, high debt levels can increase financial risk and make it challenging to secure future financing. Equity, on the other hand, does not have to be repaid and does not burden the company with interest payments. Issuing equity allows companies to raise capital without incurring debt. However, equity financing dilutes ownership and may result in sharing profits with a larger pool of shareholders. Choosing between debt and equity financing or finding the right balance between the two depends on a company's specific circumstances, financial health, risk tolerance, and long-term goals.